Wall Street on pace to close out its worst first half in more than 50 years. And our next guest says get used to the volatility, especially as second quarter earnings season gets underway. Joining me now is Lizanne Saunders, Charles Schwab Chief Investment Strategist. Lizanne, great to see you. It sounds like a 20% 6-month decline. Bonds haven't been much help to investors most of the way here. You don't really think it's time to pull away from a somewhat defensive stance or to skew toward things that are more stable?
Well, I think this is an opportunity to take a factor approach. And I think there are factors that have been working consistently and I think will continue to work consistently, like low volatility and positive earnings revisions, high cash on the balance sheet, strong free cash flow. So I think there are going to be opportunities in those kind of high quality areas. And if you have a long enough time horizon and a decent risk tolerance, there's no reason not to nibble. In the case of the S&P, the average stock in terms of maximum drawdown from 52-week high is 30%. It's 50 for the NASDAQ and Russell. I just think the market hasn't reflected yet the likely weakness that is to come, both in terms of earnings as well as profit margins. So that could be the next leg of volatility that we have to wade through.
Yeah, I mean, it certainly seems as if perhaps if it ended here, that would be kind of the lucky scenario, and maybe the whole process has not worked its way through fully. You talk about a factor approach, or rotating, rebalancing into certain factors that have sort of quality attributes, as you mentioned there. We've been talking a lot as we get to the end of the quarter about this idea that, well, stocks have underperformed so much, big asset allocation portfolios will be rebalancing into equities because it's the end of the quarter. You, I think, advocating a different approach in terms of when to decide to reshuffle a portfolio, not just based on the day and the date.
Right. And there are a lot of individual investors. Certainly the mutual fund world tends to do calendar-based rebalancing. In the case of mutual funds, it's every quarter. So it does breed opportunities. But I think for individual investors, to the extent that they can manage it in terms of the implications of turnover, tax implications, there's a lot of considerations, but volatility-based rebalancing. So maybe movements in certain asset classes outside of strategic allocation ranges, that's one way to take advantage of volatility by, adding low and trimming high. We continue to think the rallies look a little bit more akin to bear market rallies, counter trend rallies. I think we've had the washout in attitudinal sentiment measures, but we haven't yet seen it to the same degree in behavioral measures, be it the put call ratio, even the VIX, fund flows, and that may have to be the next leg, hopefully the final leg. I mean, bear markets don't end in perfect playbook fashion. If they did, this would be really easy, and it's not really easy. But I think that there's probably more volatility to come, especially during earnings season, and of course, ongoing Fed concerns.
Well, exactly. I mean, tomorrow we're going to get, we keep talking about the PCE inflation indicator, but of course that comes alongside personal income and spending, all part of the same batch of reports. So it's going to be saying something about both big concerns, right? Whether we're stalling into something like a recession and whether we've seen peak inflation. Where do you think we are in both of those potential processes? Yeah,
and I agree with you. I think personal spending and income is particularly important, especially given the pretty significant downward revision to the consumption part of Q1 GDP from plus 3.1 to plus 1.8. That's still positive, but that's a big hit. And that had been one of the primary pillars of support for the non-recession camp folks, that we had this sort of maintenance of a high level of consumption, and some of that kind of got knocked out with that revision, and the trends are not looking great in the second quarter. I think recession is the more likely case, just given the extremes of monetary policy, as well as just combating a 40-year high in inflation, the fact that we already had a contraction in growth in the first quarter and simultaneously trying to shrink a $9 trillion balance sheet. I'm just not sure how that needle points more towards soft landing. And if it is a recession, it is possible, just based on how the NBER goes about the declaration moment and the dating moment, which could still be down the road, we may find that, as you and I are having this conversation, that we're already in one. If indeed the aggregate peak in the data they track, which includes personal income, includes industrial production, payrolls, and business sales, has already peaked or is in the process of peaking.